Day 01, the announcement. The emergency broadcast interrupts primetime programming at 20:15 EST. No fanfare, no warning, just the Treasury Secretary's face, gaunt under fluorescent lights, reading from a single sheet of paper. Effective midnight tonight, all Federal Reserve notes, $1, $5, $20, $50, $100, cease to be legal tender. Deposit them within 72 hours or forfeit them. The United States is now a cashless society. The screen cuts to black. In the first 180 seconds, the nation's payment arteries seize. ATMs spit out cards like broken tongues. Gas stations post hand-scrawled signs. CARDS only, no cash. A mother in Tucson forks over her last physical $20 for diapers. The clerk refuses it, pointing to a Treasury QR code taped to the register. By 2047, the cashless effect, documented across 71 studies spanning 40 years, activates. Consumers spend 12–18% more when swiping plastic versus counting bills. Science Direct, 2024. But tonight, the effect is inverted. No one can spend what they cannot access. At 21:03, Bitcoin spikes 23% on Kraken. Gold leaps $87 Oz in Sydney. The dollar index, measured against a basket of currencies, falls 1.8% in 6 minutes, the fastest slide since Lehman. Inside the Federal Reserve's New York vault, 6,200 metric tons of gold sit unmoved, but the $1.8 trillion in paper bills circulating outside banks, 9.6% of GDP, up from 8.1% in 2011 BCG, 2019, becomes contraband. At 22:11, riots begin in Nashville, not over ideology but over bread. The Walmart on Gallatin Pike refuses cash. EBT cards fail under 4,300% server load. Local police escort pallets of groceries to shelters under armed guard. Midnight arrives. The Treasury's enforcement algorithm, nicknamed Cerberus, flips every serial-numbered bill to invalid. Cash dies not with a bang, but with a barcode. Chapter 2, The First Ripple. Day 27, Velocity Collapse. M2 velocity, how fast money changes hands, plummets 38% in 5 days. Historical parallel. During India's 2016 demonetization, velocity fell 33% when 86% of currency was cancelled overnight. CEPR, 2019. In the US, the hit is larger because Theban is total. Cash had financed 26% of all transactions under $25, San Francisco Fed, 2023. Now those trades vanish. Farmers' markets wither. A Georgia peach grower dumps 14,000 pounds of fruit. His rural customers lack bank accounts. The unbanked 1 million households, disproportionately Black and Latino, are locked out of commerce. FDIC, 2023. By day 3, barter surfaces. Cigarettes trade at 75 cents each in downtown Detroit, mirroring Weimar Germany, where smokes replaced marks in 1923. Wikipedia. A Phoenix carpenter offers a week's labor for a single .22 caliber cartridge. The New York Fed's internal memo, leaked on day 5, projects a 2.1% GDP contraction in Q1, equivalent to the 2001 recession, but admits the model cannot calibrate behavioral panic. On day 6, Congress invokes the Coinage Act of 1965, minting fresh $1 coins stamped legal tender digital bridge. The Treasury airdrops $2 billion in coins to post offices. Citizens scoop them up, only to discover most vending machines haven't accepted coins since 2019. Chapter 3, The System Shock. Month 1, the 75% liquidity hole. 30 days in, currency in circulation has fallen 75%, the same magnitude as India's shock, but without the promise of reissuance. Nightlight satellite data, the proxy used to measure India's informal economy, shows U.S. urban activity down 11% year-over-year. Chodororik et al., 2019. Credit card delinquencies rise 42%. Auto loan defaults hit 6.8%, surpassing 2009 levels. The reason? 38% of gig workers, paid in cash the day before the ban, can't clear weekly earnings into banks fast enough to cover auto drafts. Big box retailers pivot. Walmart installs cash-to-card kiosks. Customers feed in physical bills, receive a prepaid Visa minus 4.5% fee. The company pockets $140 million in month one conversion revenue, corporate rent extracted from monetary chaos. Small banks buckle. Rural institutions with 40% cash deposits watch net interest margins compress 110 basis points as the Fed holds the digital Fed funds rate at 5.25%. 5 Florida community banks request FDIC assistance. 2 are consolidated into larger zombies. Argentina's 2001 Corralito echoes. The government there froze deposits to stop bank runs. Here, the Treasury froze currency itself. Argentine households responded by hoarding dollars under mattresses, colchonismo, and GDP contracted 10.9% in 2002, Claremont McKenna thesis, 2023. The U.S. shadow rate, measured by overnight Bitcoin volatility, now implies a similar 9–12% real GDP shrinkage within a year if adaptation fails. Chapter 4: The New Order. Year 1: Adaptive Institutions. 12 months after the ban, physical cash is a museum relic, literally. The Smithsonian opens Paper Dreams, an exhibit of defunct $100 bills once used to buy homes. The Fed launches Fed Wallet, a central bank digital currency, CBDC, running on a permissioned blockchain. Every citizen receives a custodial wallet keyed to social security numbers. Privacy advocates riot. Transaction histories are visible to 23 federal agencies. Economic theology splits into 3 sects. The digitists, urban professionals whose real wages rose 3.2% via automatic tax withholding refunds. The barterists, rural counties, where 19% of trade now occurs in time dollars, tracked on garage-built apps. The gold cloaks, an estimated 4 million Americans who converted 401 KS into physical gold stored in private vaults, paying 12% premiums and a $200 annual security tithe. Sweden, where cash is already 1% of GDP, becomes the template World Economic Forum, 2018. But Sweden achieved cashlessness over 15 years. The US tried in 72 hours. Inflation, paradoxically, is subdued. 1.4% core CPI because velocity remains 22% below pre-ban trend. Yet asset inflation rages. Home prices in dollar terms rise 14%, but in gold terms fall 9%, revealing a bifurcated economy. Congress passes the Monetary Reconciliation Act, forgiving $600 in unpaid overdraft fees for anyone who surrendered at least $500 in cash. It is the largest single wealth transfer, $41 billion, to the unbanked since the Earned Income Tax Credit. Chapter 5: The Legacy. Year 10: The Rent Dollar. A decade on, the dollar still exists, digitally, but its symbol is the rent dollar, a unit of account backed 30% by gold, 30% by Treasury land holdings, 30% by future tax receipts, 10% by IMF special drawing rights. The recipe mirrors H. Jalmershak's 1923 Rentenmark that ended Weimar hyperinflation. Wikipedia. Cash is minted only as commemorative polymer tokens sold to collectors at 4 times face value. The Treasury earns seigniorage of $2.4 billion annually. Physical crime morphs, bank robberies vanish, but account hijackings rise 800%. The largest heist, $1. 7 billion drained from 430,000 Fed wallets in 2031 was executed by a North Korean phishing syndicate that cloned SIM cards in rural Ohio. Economic inequality, measured by the Gini coefficient, improves from 0.414 2024 to 0.388 2034. The reason? Automatic real-time tax collection eliminates the 16% of income the top 1% previously sheltered in cash transactions. Yet wealth concentration among the data-rich, those owning AI micropayment toll roads, replaces the old cash aristocracy. GDP growth averages 1.1% over the decade, slow, but without the 1923-style social collapse, because the state never lost the monopoly on unit of account. The final scene, a great-grandmother in Nebraska teaching her granddaughter to fold an origami crane from a brown 1996 $20 bill, illegal tender now art. The paper rustles like dry leaves. The child asks what in God we trust meant. The elder replies, "We trusted the paper, then the paper died. Now we trust the code until the code dies too."